My name is Patrick McClatchy. I'm an investor relations manager at PPR Capital Management. We are based out of Philadelphia, been around 18 years. We were founded in 2007 by Dave Van Horn, who's on our next slide here. You may be, I'm sure at least a handful of you are familiar with Dave Van Horn. He's a co-founder and a current board member of PPR Capital Management. Been around the real estate industry for several decades. Before founding PPR, he was a realtor and mortgage lender himself in the greater Philadelphia area and a longtime real estate investor with probably 40 to 60 real estate investment properties still today. He's also the author of Real Estate Note Investing. And as you can see, been a big part of the organization Bigger Pockets now for almost 20 years. If you're a real estate investor or have done your research, anything of that nature, I'm sure your paths have crossed with Bigger Pockets, one of the largest real estate investing educational platforms probably out there in the United States, as far as their environments, meetings, events they host, podcasts, speaking forums, you name it, they pretty much do it all. So again, if you're a real estate investor yourself, you've probably heard or seen Dave's name somewhere along the line. A little bit about the private equity industry and alternative assets as a whole. Most of you are probably already ahead of the game here since you're investing in self-directed IRA platforms, which again is only growing pretty quickly throughout the United States for a handful of reasons. But a few statistics I wanted to put up on the screen here so you can see. U.S. retail investors, which is all of you on the call right now, were in fact of 122 billion pouring into alternative investments in 2024. That's the highest year yet to date in our history. Projections are showing that retail investors will fund over half of private market capital by the year 2027. And lastly, 26% of Americans plan to go into alternative investments in the coming years, with active investments and going about 25% of their portfolio, which equates to about $1.3 trillion going into alternative/private equity investments. A couple reasons there, obviously with fluctuations in the stock market, especially people in their 50s and 60s looking to stabilize their returns and income as they're closer to retirement and less cash flow coming from maybe a job of some sort, certainly equate to why this is an increase. And in popularity, PPR ourselves, we can certainly attest to this as well. We are 100% as far as retail of where our capital is coming from. So the past 3 years, we've averaged over 100 million in capital raised per year. And again, this is 100% from retail investors. This is not coming from institutional or family offices, just to really emphasize the strength of how much retail investors are coming into the private equity space, which is great in my opinion, because getting access to the right investments is more coming towards the common man and not just your institutional capital. Again, going back all the way to the beginning, these were our three founders, Dave Van Horn, John Sweeney, and Bob Paulus. Dave Van Horn was usually the face of the company again, so you probably haven't heard or seen of our other two founders, but most likely we have with Dave. They figured out a very unique way to invest in real estate. And what I always like to tell investors when I'm on a call with them is it is the number one way to invest in real estate, but still be extremely liquid. To give a synopsis of that, what they're really doing is purchasing real estate-backed assets at a discount and producing cash flow on the back end. So what exactly they're doing is purchasing non-performing and reperforming residential mortgages. What that does for them is, again, you're still investing in a hard asset, but you don't have tenants, maintenance, or property management. And I'll certainly get into a lot more of what exactly a note is and what you're investing in. PPR today, we do have an 18-year track record. We have perfection with never missing an interest payment to our investors, never losing a dollar of investor capital. About 1,800 plus current investors at this time. I mentioned earlier 1.2 billion assets under management at this point, and just under 500 million of equity under management. This is our Reliant Income Fund. This is our flagship fund, essentially been around since we've been founded in 2007. It's had a few different names, but ultimately the same fund and same structure. What it looks like in a breakdown is mortgage notes, and commercial real estate. And what I mean by commercial real estate is 100+ unit residential properties, just to clarify that. So what is a mortgage note? This is a promissory note. It's a legal document that the borrower or homeowner has to pay the money that they've borrowed, aka their mortgage. So let's jump into how we are kind of investing in these mortgage notes. So a lot of times large banks are forced to sell off their non-performing residential mortgages. And again, a non-performing residential mortgage is exactly what it sounds like. The homeowner or homeowners are behind 90+ days on paying their mortgage on time. The number one, a large bank, which I'll use like a Wells Fargo, for example, sometimes they're actually forced to sell off these non-performing residential mortgages because they can only have a certain percentage of bad debt on their balance sheet at any given time. Or number two, they just don't have the employee base or time or honestly care to actually go through and solve or resolve all of these non-performing loans. They'd rather just sell them at a discount, collect the capital they can get back, and kind of move on to their next investment. That's where PPR comes in. So we'll purchase 25 to $100 million worth of non-performing residential mortgages at a time, typically at a considerable discount. When I can say considerable discount, maybe 60 to 65 cents on the dollar, for example, right now. And then what we're looking to do is a few different things once we capture and own these non-performing residential mortgages. So again, we're purchasing about 25 to $100 million worth at a time. Average home price, 350 to 450,000. That's only increasing. That's probably already outdated if I made this like a month ago. Slowly increasing, just typically with the home value appreciation in the United States. We are always first lien position. I have a funny story that I'll go back to in a little bit about when Dave founded the company initially, but ultimately we're far too large to be taking any risk beyond being first lien position on these properties. And we are in all 50 states. As far as diversification goes, that's one of our key demographics to make sure we're all 50 states. Certainly more heavily weighted in certain states, depending on foreclosure processes and laws in that given state, but ultimately we are in all 50. So to wrap up how we essentially make profit on these non-performing and reperforming loans, we bought $100 million worth of non-performing residential mortgages at 60 cents on the dollar. We only purchased non-performing mortgages that were originated in the years 2010 to 2014 for a couple of reasons. Number one, it ensures there's quite a bit of equity in this home, which causes you have a homeowner that's going to probably be more motivated than you are to convert to reperforming to keep their home. The average American, the bulk of their net worth is going to be in their primary residential equity. Number two, it also gives us sort of like an insurance policy on ourselves, because if the homeowner does not work with us to start paying the mortgage and ultimately become a reperforming loan, we can foreclose on the property and then we capture the equity on the back end. So why I'm stating this on the slide here, how we're getting out of every single deal is A, through the borrower, meaning they're going to start paying their mortgage, or B, through the property, we're going to foreclose and sell it at market value. Couple things there. So I keep stating the term reperforming loan. The definition of a reperforming loan is essentially the homeowner is paying their mortgage back on track for 12 months consecutively. Once that is acquired, ultimately any bank in the country would be looking to purchase that loan back from us, again, because it's reperforming. We bought it for 65 cents on the dollar. A bank would take a reperforming loan for probably 90 cents on the dollar. For, again, very general numbers and examples here. You're probably wondering, why is the homeowner all of a sudden willing to start paying their mortgage just because PPR bought it from Wells Fargo? The most common strategy there is a loan modification, not a refinance. And I use that key term particularly because there's a couple of advantages with that. With a loan modification, you can actually keep your current rate and not have to take market rate. And why that's important is because in the dates that we were purchasing these non-performing loans that were originated in 2010 to 14, their mortgage rate is probably 4 to 4.25, which, as I'm sure you're familiar, is much lower than what current market interest rate is right now if you purchased a home or refinanced. So typically we can take their, let's say they have 15 years left on their mortgage, we can kick it back to a 30-year. They keep their interest rate at 4 or 4.25, and are now able to sufficiently pay their mortgage on time. The most popular or common reason why someone's behind on the mortgage is one of the two income earners in that house was unemployed for 6 to 9 months, and that's what got them behind. We lower their payment, they're employed again. Ultimately, they're able to get back on track paying their mortgage. How often does this happen that they go from non-performing to reperforming? About 75% of the time historically in our 18-year track record. So every 3 or 4 non-performing loans are going to convert to reperforming. We look to package them, usually do a refinance of some sort and sell off the reperforming loans to banks, and then essentially rinse and repeat. We take that money and profit that we made, look to buy the next package of non-performing residential mortgages. And here's 2 case studies I'll show you of specifically what we did, 1 on converting to reperforming, and 2 on the foreclosure. So this was an unpaid principal balance or mortgage that was left that they owed of just over $106,000. We purchased this non-performing mortgage for $65,500. We converted it to a reperforming loan, sold it that exact loan for just over $78,000, and got a gross profit of just under $13,000. Hold period was 7.6 months. And again, resolution was a reperforming loan sale. One keynote I like to take here is when I mentioned when we purchased in 2010 to 2014, we're very keen on and always paying attention to the loan to value. This is a pretty extreme instance, but ultimately this is a pretty safe investment, you should say, with us purchasing the loan for $65,000. And we had a $470,000 asset backing up this loan. So worst case scenario, they didn't start to pay their mortgage. We would convert this, foreclose it, and look to sell it at market value. So again, just want to emphasize everything we're doing in this fund essentially is backed by a hard asset.
So Patrick, I already got a question in the chat.
Sure.
You're talking about the positives. Where's some of the risk?
Yeah, sure. So what risks are associated with purchasing non-performing loans?
Correct.
We are more profitable on the reperforming side of things. So we're more profitable when we convert the loan to reperforming and sell it off. How can we get caught with risk? Number 1, a sharp increase in unemployment in the United States. Why is that? At any given time, we probably have 4,000 to 5,000 plus non-performing or reperforming loans in our Reliant Income Fund. If the unemployment rate were to increase in a short amount of time pretty sharply, we would get caught, quote unquote, holding the bag, for lack of a better term, meaning more of our non-performing loans are going to convert to foreclosure than reperforming. So when we purchase this tranche of $100 million worth of loans, we're underwriting each individual loan before bidding on how much we want to pay for it. From what the loan to value is, geographic region, what state is it in? Every single state has different foreclosure processes. We have to take that into account. The likelihood this homeowner is to actually convert to reperforming versus foreclosure. So if a sharp increase in unemployment rate that were to happen while we are owning that $100 million tranche of non-performing loans, that's going to decrease our overall return on that tranche of non-performing loans that we were not able to predict accurately. Number 2, probably the more obvious one, would be a sharp decrease in home value. Loan to value shrinks. Homeowners probably less likely to want to work with you reperforming if their home value shrinks. There's less equity in that home. And number 2, our profitability on the foreclosure side shrinks, obviously, because when we sell these homes at market value, it's less profitability.
Second question popped up. Debbie asks, how much on an average does PPR have to put into a house that you foreclose to bring it up to its current market value?
Usually $0. We are not in the business of fixing up the loan before selling it. We're usually foreclosing and selling immediately. In the most extreme case I can give you is usually the state of Texas. We buy quite a few non-performing loans there, mainly because of the foreclosure process is 90 days. So it's a very quick turnaround as far as how we can get our money back and make a return on it. Most instances, we're foreclosing as fast as possible, taking that asset as is and selling it at market value. Now, that's not to be said sometimes, and I think my next case study might even have that we put some money back in. That's not to be said sometimes if we do see the value there to put some money into the home before selling, we will do so. But quite frankly, we do that probably less than 4% of the time. So my general answer would be usually $0 being put into the home before selling at market value. Here's another case study. So the last case study I showed, we exited through the borrower. They started paying and we sold that loan. This is a foreclosure. So the unpaid principal balance was just over $1 million. We paid $321 for it, and the whole home sold for $481. So our gross profit, excuse me, was just under $160. Total hold time, obviously you're going to see this every single time. Hold time is longer here. If you look back at the reperforming loan, that was a 7.6-month process. Anytime it's a foreclosure, it's probably going to be a longer term, just because we have to go through legal and courts, etc. But ultimately, it was foreclosed on and sold. Again, just to show here the difference: acquisition price, gross profit, and home value. We bought that loan for $321 with a home value of $525. That's really just me trying to emphasize what we're investing in and what it's backed by. And here's like a very generalized snapshot of an entire trade that we purchased. So we purchased a tranche of non-performing residential loans, 155 million in total for 548 loans. Total unpaid principal balance, 153 million. Total property value was 233 million. Just to emphasize that a little more. What is being broken down over here, I want you to look at how we're exiting. So here's your foreclosures, your note sales. These two are essentially the same thing, just a heads up. Note sale, that's selling at non-performing or reperforming loans that converted, and somebody else essentially doing it for us. But these are both non-performing loans converted to reperforming loans and then sold off accordingly. Payoffs, which I have not touched on, but this is actually a good example because we probably do average a little less than 12%, is probably closer to 10%, that the homeowner will actually just pay off their mortgage in full. This usually happens from a relative, friend, family member, whatever the case may be, just to make sure they get from out of water and get to keep their home. That is still a win to us. Again, because the loan that's left, just keep numbers simple, is they owe 100,000 still. We bought that loan for 65,000. They pay us 100,000. That 35,000 they paid over is just profit to us. But payoffs are typically about 10% in any given tranche of not performing residential loans that we'll purchase. What's down here at the bottom are still just unresolved. So these are reperforming loans that are just cash flowing. We haven't sold them yet. Active REOs and active other. Active other is also reperforming loans that are less progress made. So they've probably only paid 1 to 3 months and we're still just getting them up and running to add more value of what they're worth to become stronger reperforming loans. To give context there, a reperforming loan that has 1 month of history is not as valuable to a bank as a reperforming loan that has 12 months of history. But ultimately, these banks will buy them at any given stage of where they're at. It's just what they'll pay for them. Most typically, we're going to wait 12 months before selling, but that's not a one size fits all. We certainly will sell them earlier if it's the right price in our opinion. What I just covered with you were our non-performing and reperforming loan side of this overall fund. Again, I really want to emphasize the Reliant Freedom Fund is a fund of $1.2 billion in assets. How I like to describe it to some people, especially people who are syndication investors. For example, you do a syndication with one multifamily property. This is sort of like you investing in real estate. and is the version of the S&P 500 of real estate. You invest in the Reliant Freedom Fund, you're immediately diversified across all $1.2 billion of assets. You are not tied to one specific tranche of non-performing loans that we purchase. You are not tied to one specific multifamily project that we invest in. A lot of people get confused on that, thinking you're depending on when you opt in, it's whatever kind of asset was purchased next.
So happy you emphasized it a little bit. So just for those that are listening, a lot of you invest your retirement dollars or personal dollars within a one-off syndicator, right? The reasons why this is maybe more appealing to an IRA or 401k or HSA is, as Patrick described it, it's a pool of investments. Okay. That's what makes it so risk friendly, if that's the right way of saying that. Okay. You're not just tied. If one, like if one deal goes under, God forbid, I'm just saying Patrick out loud, it won't affect you as much, all right, as just like a syndicator or a syndication would go to the side. Now, the other thing that I actually want to talk about, Patrick, because this question just popped up in the chat, is one person actually asked me about UBIT or UDFI. Does your fund trigger that?
Great question. It does not. So this is why I'm emphasizing the Freedom Fund, and somewhere in the slideshow it probably says Reliant Income Fund. We set up a specific way for self-directed IRA investments to invest in our fund, and you are entirely protected from UBIT.
So that Patrick, guys, for everybody that's listening, that's why I wanted to drag Patrick by his neck over to the IRA club. I'm kidding, Patrick. Is because this fund appeals to you individuals, meaning for those that want to use IRA dollars, not particular 401ks, because 401ks don't trigger UBIT or UDFI, but the actual fund itself, which is an evergreen fund, will never trigger UBIT or UDFI, unrelated debt financed income. Syndications do. 99.9% of the time they do. And the next question, somebody just asked just now, what is UDFI or UBIT? I will show you where to find that on the IRA Club website. We actually revamped that page. But just let Patrick finish his presentation. I'm happy you bought that up. That's what makes this fund so appealing, and PPR very appealing for a retirement account.
Yeah. I'll jump back in just to touch on that another second. A couple things there. That's a huge part of our success in why we've reached out to more and why I've wanted to get closer with specific IRA companies such as IRA Club. And believe you me, they're one of the best out there. I've dealt with probably over 20, and it's important to be with the right partners, again, for educational purposes. But B, us not having any type of UBIT tied to your returns has been extremely important to our investors. To give you context, almost over 40% of our investors at this point in our fund are coming from a self-directed IRA. It was vital for us to find a solution for this because of the importance. Again, going all the way back to my beginning of presentation, how much retail capital that's going to alternative and private equity investments. That was a problem that we needed to solve much sooner than later. Just a couple more minutes here, and then I'll certainly wrap up for Q&A and more open forum conversation. This is the other side of this Reliant Income Fund. Again, I want to emphasize the fund as a whole. This is about 30 to 35% of the $1.2 billion in assets at any given time. What we're specifically investing in is 100+ unit residential properties. We are not in our typical ground up builds. We have one, but there's a very specific reason as to why. We take the same strategy with multifamily as we do with non-performing loans. We're looking to purchase these in some type of distress and get them at a good discount. For example, 2024 brought us a lot of opportunities with contractors that could not afford their variable debt. They're now underwater, pretty much at a forced sale, and we get to go in there. We purchase it typically at a 10 to 15% discount, take over the project, look to do value adds like rehabs to the units or complete the projects itself, look to occupy or get as much occupancy in the building itself, and then look to sell. If you haven't seen or could tell by now, we are very strongly opinionated on short-term investing. It mitigates a lot of risk of future market conditions, such as not being as concerned with the unemployment rate going up or home value appreciation or depreciation. When you can get in and out of investments quicker, it mitigates the vast majority of your risk. So with our multifamily, these are typically 3 to 4 year hold times before sale. And again, just to touch on what I have on the slide here, two of our strategies, it's either value add or affordable housing. We did one ground up build in Austin, Texas, where the first 50 tenants in the 100-unit building had to be local teachers or firefighters or policemen. That gave us a 100% tax abatement, which made it very enticing as far as profitability goes. And by the time we sell, which we're probably going to sell in September of this year, actually, there's still quite a bit of years left on the tax abatement. There'll be 7 and change, making it still very attractive for the next buyer. To wrap all this up and put it in a bow here, again, this is all the Reliant Income Fund. That's the exact same thing as the Reliant Freedom Fund, which you would go into the Freedom Fund to protect you from UBIT. They have the exact same offerings, and I'll run through them very quickly here. We have 3 rate options, rate and term options at this point. We have a 1-year lockup period of your capital, offering you an 8% annual return paid monthly, or you can compound it, essentially reinvesting your monthly distributions for a higher return. We have a 2-year lockup period, offering you a 10% annual return paid monthly or compounded for a higher return. And then we have a 3-year lockup period, offering you a 12% annual return paid monthly or 14.38 compounded. The 1 year is a 50,000 minimum, the 2 year is a 75,000 minimum, and the 3 year is a $100,000 minimum. And then just want to emphasize at the bottom, qualified plans accepted, solo 401ks, self-directed IRA, which all of you probably have. And it's a great investment opportunity compared to some other options, again, because you're protected from UBIT, which UBIT could be as high as 30+% depending on the project or leverage that's used.
All right. Somebody says, so did I hear correctly that if investing in an IRA, no UDFI? That's what
Correct.
Debbie makes this fund so appealing. Is there is no.
And if you're nervous about going into the wrong offerings, I have a full internal team that helps you every step of the way. They know to automatically put you in the Reliant Freedom Fund if you're coming from IRA Club to ensure that you will not get hit with any of this.
All right. Take care, everybody. Thanks, Patrick.
Awesome. Thank you very much.
You're welcome. Bye-bye.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.